You are sitting there looking at your brokerage account thinking you are an absolute financial genius because you watched two prominent personal finance creators debate an abstract percentage on an internet video. But you are completely blind to the reality that complexity is just a status signal for individuals who want to feel intelligent while staying thoroughly poor. If you cannot explain your long-term retirement withdrawal strategy to a 12-year-old child without relying on rigid formulas and theoretical models, you are not actually executing a sustainable wealth plan. You are just gambling your future on a set of historical averages that have absolutely nothing to do with your immediate financial reality. Let us be entirely clear about the cold mathematical facts because the numbers do not care about your emotional comfort, your hyper-conservative spreadsheets, or your lazy assumptions regarding how capital behaves over a 30-year horizon. You think that by anchoring your entire life to a generic 4% rule, you are practicing sophisticated risk management. But the truth is, you are just letting a fear-based narrative dictate your standard of living while your dormant liquidity sits inside passive retail buckets that Wall Street trades around every single day. People love to overcomplicate the concept of a safe withdrawal rate because it gives the financial advisory complex a convenient excuse to charge you recurring management fees for doing absolutely nothing. But real freedom is about the simple, boring discipline of adjusting your spending according to raw market conditions instead of praying for a permanent bull market. The broad financial media loves to trigger massive panic in the comment sections. The second anyone mentions a withdrawal rate higher than 4%, completely missing the structural truth that the original research behind these metrics was explicitly designed to survive the absolute worst sequence of historical returns rather than represent a typical human experience. If you enter retirement with a massive portfolio and blindly restrict your personal consumption because you are terrified of a hypothetical worst-case scenario that occurred 60 years ago, you are actively failing at the game of wealth creation by choosing to live like a pauper while sitting on a mountain of unspent capital. First and foremost, we need to completely dissect where this absolute obsession with the 4% rule originates, because the contemporary understanding of this guideline is fundamentally detached from the actual data that created it in the first place. William Bengen conducted the foundational research to discover the absolute maximum withdrawal rate that would have survived the single most catastrophic economic environment in modern history, meaning the number was never intended to be a baseline recommendation for the average retail investor. The original calculations yielded a baseline of 4%, which was later adjusted to 4.5%, and modern expanded datasets have pushed that worst-case boundary closer to 4.7%, yet the public continues to cling to the lowest possible figure out of pure psychological inertia. Bengen himself explicitly stated that the vast majority of historical cycles allowed retirees to safely withdraw significantly more than the baseline minimum, with over 99% of historical horizons supporting much higher distribution rates without ever risking premature portfolio depletion. The legendary 4% baseline represents a singular, highly specific individual who had the absolute misfortune of retiring into the absolute teeth of the late 1960s and early 1970s market crashes, while simultaneously facing rampant structural inflation. That specific historical counterparty took an inflation-adjusted distribution every single year for 3 consecutive decades without ever modifying their lifestyle, without ever implementing portfolio guardrails, and without showing an ounce of behavioral flexibility during a massive equity slaughter. That is the exact scenario that 4% protects against, meaning it is an extreme outlier protection mechanism rather than a logical framework for a modern individual who possesses the basic intelligence to modify their expenses when the macro environment shifts. When you hear the mainstream advisory complex declare that you must stick to a rigid 4% distribution, they are fundamentally misinterpreting the empirical data because that rate was never a statement of what you should spend. It was simply a statement of what managed to survive the worst economic nightmare on record. Understanding this distinction changes the entire paradigm of long-term wealth preservation because it forces you to realize that building a rigid retirement plan around a single static number is an exercise in pure financial laziness. The typical real-world retirement experience across rolling 30-year periods looks completely different from the terrifying headlines, with the median historical cycle easily supporting a permanent 6 to 7% withdrawal rate without any threat of asset exhaustion. In fact, individuals who had the immense good fortune of retiring right before the onset of a major secular bull market could have aggressively withdrawn double-digit percentages from their portfolios for 30 years straight and still left a massive inheritance to their heirs. We are not suggesting that a 6 or 7% distribution rate is a universal law that every person should blindly implement tomorrow afternoon, because declaring any single number as universally safe is just another form of passive retail dogma. What the historical distribution actually proves is that most retirees do not experience an economic apocalypse, meaning that adhering to an ultra-conservative baseline out of sheer habit forces you to sacrifice the best years of your life for a hypothetical risk that will likely never materialize. This creates a vast spectrum of opportunity where the lower bound protects you from the absolute abyss. The middle ground represents the realistic historical average, and the upper bound unlocks massive abundance during strong structural expansions. Let us bring this entire concept to life by analyzing the specific historical cohorts, because looking at the exact chronological data reveals exactly how much your financial destiny depends on macro timing versus asset allocation. If you examine the elite retirement cohorts that launched during the early 1920s, specifically from 1922 to 1952, the sustainable distribution rates fluctuated between 9 and 11%. These portfolios achieved massive capital growth during the initial stages of their retirement horizons, creating an impenetrable liquidity buffer that easily absorbed the devastating impacts of the Great Depression and subsequent global conflicts later in the cycle. Now, consider a middle-of-the-road historical scenario where an individual officially retired in 1995 and maintained their distribution schedule through the year 0.7%, surviving both the dot-com crash and the global financial crisis. This specific retiree did not possess immaculate timing and was forced to navigate multiple severe market contractions. Yet the early gains of the late 1990s allowed the portfolio to easily support a baseline 6 to 7% withdrawal rate without ever jeopardizing the principal balance. If you look at the highly lucrative cohort that retired in 1982 and concluded their horizon in 2012, you see the profound impact of entering the market at the absolute genesis of a multi-decade secular bull run. This individual experienced falling interest rates and explosive equity returns for a quarter of a century, allowing their portfolio to effortlessly sustain an 8 to 9% distribution while the broad market did all the heavy wealth lifting on their behalf. Another exceptional window occurred from 1975 through 2005, where a retiree entered the compounding cycle immediately following a massive market bottom and proceeded to ride the explosive economic expansions of the 80s and 90s. This specific timeline easily supported a continuous 7 to 8% withdrawal rate adjusted annually for inflation, granting the individual massive purchasing power for 30 years without ever endangering their long-term financial security. Now let us pause and shift that exact retirement timeline backward by a tiny margin of 2 years to demonstrate exactly how volatile a rigid rules-based approach can be when you ignore macro conditions. Imagine an individual retiring with a nominal $1 million portfolio in 1973 instead of 1975, forcing their distribution horizon to span from 1973 through 2003. The immediate aftermath of their retirement date was an absolute macro horror show featuring an immediate 45% equity market drop coupled with severe structural stagflation throughout the remainder of the decade. This is the absolute definition of sequence of returns risk, where your core capital base is violently eroded by market losses at the exact same time you are forcing the portfolio to distribute cash that must scale higher to keep pace with rampant inflation. The maximum sustainable withdrawal rate for this specific 1973 cohort collapsed down to a tight range between 4 and 4.2%, placing this scenario firmly at the absolute bottom of the historical survival spectrum. Look at the staggering real-world lifestyle disparity between these two individuals, because the actual human outcomes of these identical capital bases could not possibly be more different. The 1973 retiree with a $1 million balance utilizing a rigid 4% framework is limited to $40,000 of initial annual purchasing power, while the 1975 retiree pulling 7% receives $70,000. That is a massive difference in annual cash flow generated by the exact same nominal amount of seed capital, proving that blind adherence to a single number is an incomplete strategy that ignores the structural reality of the era. The market conditions you inherit at the moment of your retirement dictate your short-term trajectory, and the environments that consistently unlock those higher 6 and 7% distribution rates always share the exact same macroeconomic markers. First, you must capture strong positive returns during the initial years of your distribution phase, so your core asset base expands significantly before withdrawals can inflict any permanent structural damage. Second, the economy must be completely free of front-loaded structural inflation, ensuring that you do not have to aggressively step up your nominal cash distributions during the fragile early years of the horizon. When early market growth and low initial inflation occur simultaneously, a 6 or 7% distribution becomes completely sustainable. but you can only verify those conditions with absolute certainty after you have already committed your capital. This inherent macro uncertainty is the exact reason why the passive retail crowd clings so desperately to the safety of a generic 4% rule, choosing total lifestyle restriction over the discipline of executing a dynamic strategy. I am not telling you that every single human being should immediately start pulling 7% from their equity accounts, nor am I validating the ultra-conservative dogma that forces you to limit your life to a 3% baseline. The real solution to this entire retirement dilemma is to completely abandon the search for a singular magical number and build an adaptable financial framework that responds directly to real-time market valuations. Step number 1 requires you to establish a fluid distribution range based entirely on your personal risk capacity and behavioral flexibility, rather than relying on a static consensus. If you are deeply risk-averse and completely refuse to make any tactical adjustments to your lifestyle during a market downturn, you belong in a conservative starting range between 3.5% and 4%. If you consider yourself a balanced investor who understands basic market cycles, you can comfortably position your initial baseline within a range of 4.5% to 5.5%. If you possess a high risk tolerance and are entirely willing to inject absolute behavioral flexibility into your personal lifestyle, you can easily initiate your distribution schedule between 5.5% and 6.5%. This initial shift is incredibly powerful because it destroys the illusion that you are bound to a single unyielding mathematical metric and allows you to align your capital distributions with your actual psychological risk capacity. Step number 2 requires you to actively adjust your distribution rate based on 5 critical macroeconomic and behavioral pillars that determine the ultimate longevity of your capital. The first pillar is your explicit time horizon, meaning that an early retirement spanning 40 or 50 years necessitates a highly conservative starting number to protect against long-term inflationary erosion. Conversely, if you are looking at a traditional 20 or 25-year horizon, you can safely scale your initial distribution significantly higher, because the compressed timeline dramatically reduces the compounding risk of a prolonged equity market stagnation. The second pillar is the creation of a robust income floor, which is easily one of the most effective strategic mechanisms in all of wealth management. By securing reliable, non-portfolio income streams through Social Security, structured annuities, or selective private business ventures, you fundamentally insulate your lifestyle from the daily movements of the stock market, the higher your guaranteed baseline income streams. The more aggressively you can draw from your equity portfolio because your essential survival expenses are completely covered by external cash flows. Once your guaranteed external income handles your basic overhead, your equity investments exist solely to fund your discretionary luxury spending, allowing you to easily scale your lifestyle upward during bull markets or cancel luxury vacations during a severe cyclical contraction. The third pillar is spending flexibility, meaning that the absolute rigidity of your personal overhead dictates exactly how conservative your initial withdrawal selection must be. If your baseline living costs are completely fixed and you lack the capacity to reduce your personal consumption during an economic crisis, you are forced to remain anchored to the ultra-conservative 4% boundary. But if you maintain an adaptable lifestyle and can instantly dial back your personal expenditures by a small margin during an equity correction, a starting distribution of 5 or 6% becomes thoroughly realistic. Research across multiple market cycles proves that making minor, intentional reductions to your spending during negative years completely eliminates the threat of portfolio failure and permanently protects your principal. The fourth pillar is sequence risk protection, which requires you to build explicit structural buffers into your architecture so you never have to liquidate equities at the absolute bottom of a cyclical bear market. You achieve this security by maintaining a dedicated cash reserve representing 2 to 5 years of lifestyle expenses, or by implementing strict guardrails that automatically pause your annual inflation increases during negative market years. These basic structural precautions give you the absolute freedom to launch your retirement with a significantly higher safe withdrawal rate without ever exposing your core capital to permanent destruction. The fifth pillar is the objective analysis of current market valuations and starting economic conditions at the exact moment you begin to transition away from full-time employment. If you are looking at an equity market that is trading at historic valuation extremes, it is common sense to lean toward the more conservative side of your distribution range to provide an extra layer of personal margin. If you are entering the distribution phase during a major cyclical contraction when equity valuations are thoroughly depressed, you can give yourself permission to spend a bit more, because your capital is buying assets at a deep discount. This aligns perfectly with the foundational logic of being fearful when the retail crowd is greedy, and greedy when the broad market is terrified, a discipline that requires you to look at data instead of headlines. Step number 3 is to completely stop chasing a single static index number and build a dynamic behavioral system that reflects how intelligent humans actually navigate reality. The financial headlines get this topic completely wrong because they pretend that retirees are unthinking robots who blindly extract a fixed mathematical percentage every single year regardless of what is happening in the real world. Real human beings naturally adjust their behavior, automatically tightening their personal expenditures when they notice their net worth contracting and expanding their consumption when their investments are flourishing. These natural behavioral adjustments are the exact mechanism that preserves long-term capital, meaning your strategy should focus entirely on a clear guardrail system rather than a fixed academic formula. Imagine starting your distribution schedule at a realistic 5% rate with the explicit rule that you will completely freeze your inflation adjustments the moment your core portfolio experiences a defined percentage drop. If the market drop accelerates, you simply reduce your discretionary spending by a minor margin of 5 to 10%, and when the broad market recovers and resumes its upward trajectory, you reward yourself by scaling your lifestyle back up. This simplified guardrail system matches actual human behavior, eliminates the psychological terror of running out of money, and dramatically multiplies the mathematical probability of long-term portfolio success. The ultimate objective of an intelligent investment plan is not to maximize a theoretical spreadsheet metric. It is to build a retirement lifestyle that you can actually live with in the real world. You want a future where you feel completely confident spending the capital you spent a lifetime accumulating without constantly fearing an imaginary market crash or overly restricting your life out of pure ignorance. If someone asks you whether a 7% withdrawal rate is safe, the most sophisticated answer you can ever provide is that the safety depends entirely on how you choose to manage the behavioral guardrails. Retirement is not a static math problem to be solved with a rigid textbook rule. It is an ongoing process of adapting your capital to an uncertain and constantly changing macroeconomic landscape. The individuals who achieve true financial sovereignty are those who maintain absolute flexibility to rotate their strategy along the way, while the passive majority stays paralyzed by fear. Stop allowing rigid definitions of diversification to average down your standard of living. Respect the basic laws of capital velocity, and let the undisciplined crowd fund the counterparty risks while you quietly enjoy the true freedom of a flexible life.